All right, let's talk income. Like I mentioned earlier in the videos, in the pre-approval process, income and calculating that income is one of the most important steps in the home buying process. We want to make sure that we have things calculated very, very accurately, because not only does this ensure a smooth loan process for you, it also ensures that we're maximizing your pre-approval potential. If you are trying to push the envelope and get pre-approved for as much as possible, having accurate income is absolutely vital to making sure that we can give you as much purchasing power as we possibly can. There are a lot of different kinds of income. So the first kind of income we're going to touch on is just W-2. This is what most people are. You're typically hourly or salary when you are a W-2 employee. So if you are hourly, we'll want to confirm if you're full-time, part-time, do your hours vary? We want to make sure we've got those questions answered up front. And then what we'll usually do is just take your hourly rates multiplied by your average hours worked per week. And that is how we come out with your average income. So we'll take your weekly income, multiply that by 52 weeks in the year, divide that by 12, and that is how we come up with your gross monthly income. If you have shift differentials or paychecks that your hours vary, we'll need to dig in a little bit more on those details and make sure we're getting a really accurate idea of how many hours you work, what does that shift or night or weekend differential look like. Basically, we just may need to do a little bit work on certain kinds of income. If you're salary, usually that makes it pretty easy because we'll just take your annual salary and divide it by 12, or your monthly salary and use that. Again, we use the gross amount. We don't go off of the net. That is one of the beautiful things about buying a home, is when we qualify you, it's based on your gross income and not your net income. A couple things to keep in mind is if you received a raise or any change in pay recently or within the last year, make sure you are noting that for your loan officer. If your year-to-date average of your income is off, we're going to want to know why. If you got a $5 an hour raise 2 months ago, it may make perfect sense why your year-to-date average looks low, because it just hasn't had enough time to catch up and catch up past those 2 months where you were receiving less per hour. So just make sure, again, that you're just being super detailed when talking about your income with your loan officer, so that we can make sure we're calculating your income very, very accurately and very, very fully. Tip income is something that we see quite a lot of, and it is something that can be a little bit harder to calculate and report, because many folks who are in service industries receive cash tips, and a lot of them don't receive that through payroll. There are some companies that do that, but if you are receiving cash tips, you want to report those on your tax returns. If you're not reporting your cash tips on your tax returns, we can't use that as qualifying income because we can't document it. So if you're receiving cash tips, not through the payroll service of your employer, you're just receiving cash that you're depositing to your bank account, you need to be documenting that in order to use it as income on a home purchase. When you are using tip income, we also need you to have 2 years of tip income history to use that tip income at all. This is a hard and fast rule across the spectrum of different loan products. If you have tip income and you're wanting to use it to qualify, you need to have been able to prove that you've been receiving tips for a minimum of 2 years. So this all comes back to being super detailed and being super upfront with your loan officer about your income, about your employment, so that we know what to ask for and what to look for and how to help you get us what we need. The nice thing about tips that are reported through your employer is they typically show up on your W-2 as a separate line item as well. So it's pretty easy to track for prior employers for what tip income you received in prior years. 3 other common types of income that we see are bonus income, overtime, and commission. So these types of income, we would like to see 2 years. The investors, Fannie and Freddie, FHA, VA, would like to see 2 years, but a lot of the time we can make a case for less than 2-year history. So again, we do need to be able to document this either via a verification of income from your employer or via prior year's pay stubs, end of year pay stubs. We'll take an average of this income to qualify you. So we'll average it out over the time that you've been receiving this income or over the most recent 2 years, whichever is greater. And then if your year to date income is declining as compared to previous years, we're going to need a good explanation for that. For example, if you work as a bartender, you probably get more tips around the holiday season when people are being more generous. So it may look like a lower year-to-date income through the summer months, but then once you hit in the fall and winter, your tips increase drastically. If it makes sense and we can document it and tell the story, we could probably make it work. Self-employment. There are a few different kinds of self-employment that we see on a regular basis. By far the most common is what we call a sole proprietor. This is where you're self-employed, you don't receive a W-2 from an employer. You may receive a 1099 if you are an independent contractor, or maybe you just own your own business and you file your taxes that way as a Schedule C on your personal tax returns. So we will typically need 2 years of personal tax returns in order to use this type of income. If you have been self-employed for 5 years or more, and we can document that, we may be able to get away with just the most recent year of tax returns. What we do is we take the net amount of your Schedule C. So you got your gross receipts, then you subtract out, your expenses, deductions, things like that, and that's how we come up with your net income. So we take your net income, we can add back a couple of things like business mileage, depreciation, depletion, business use of home, some of those things we can add back. And then we take that number and we divide it by 12, and that is how we get your average qualifying income. We typically will need a profit and loss statement if we are past the first quarter of the year. And a lot of times we are going to need 1 or 2 months of business bank statements if you have them as well, just to support that the business is still progressing, making money, and doing as well or better than previous years. If you have a partnership or a corporation, you will be filing a separate business tax return in conjunction with your personal return. So typically when you do this, if you are more than 25% owner of this business, we will need to get copies of those tax returns. Income will be calculated a little bit differently depending on how you file taxes. So talk about that with your loan officer. It is more of a case-by-case basis when it comes to this, but again, it's just so important to be detailed and have all of your documentation. So if you know you're self-employed, you file partnership, you file S-Corp returns, make sure you've got those returns, that you've got all pages and can provide that to your underwriter. Again, if we're past the first quarter of the year, we will need a profit and loss statement. So make sure that you or your CPA are able to work on that for us, because it will just make the process faster and smoother and make sure that we have what we need to get you a very solid pre-approval. Rental income. So if you are a property investor and you own 1 or more investment properties, you should be filing that on your tax returns and claiming that income. You'll be filing a Schedule E. So for each property you own, you will file individually on your Schedule E. You're going to claim your total rents received from that property for the year, and then you can deduct things like mortgage interest, property taxes, HOA dues, just general property costs, upkeep, depreciation. There's a lot of things that you can write off as part of a rental property ownership when you're filing your taxes. So same as with self-employment, there are things that we can add back. We do go based off of your net rental income, but then we can add back things like your mortgage interest, property taxes, depreciation, and then we take that number and divide it by 12, and that is how we get the qualifying income for your rental property. Now, if you are purchasing an investment property, we can also use the rental income from that property you're purchasing as qualifying income towards your debt to income ratio. So basically, for example, if you're purchasing a rental property and the appraiser estimates that you can, the market rents for that property are $2,000 a month, we are able to use 75% of whatever the appraiser says that property can rent for, and that will help offset your principal and interest payment, and can just help you qualify for more, or just make sure that you can qualify for that investment property that you are purchasing. All right, fixed income, things like retirement, pension, Social Security, disability, adoption, foster income. We can use that to qualify for a loan. What we typically need for this is going to be a copy of your award letter or your 1099. We may need a copy of your federal tax return if you file taxes. Reason we may need that is if you don't have to pay any income taxes on your fixed income, we can actually gross that up by a certain percentage and give you some additional bang for your buck in terms of being able to qualify for more home purchase, or just giving you some more room in your debt to income ratio. So this is one of the easiest types of income to document and use because it's fixed, it's very easy to show, and it's not a lot of extra calculations. We just basically take, yeah, the government says this is what you receive each month. Okay, well, that is what we will use to qualify you for the loan. Asset depletion. Now, this is not necessarily income in the traditional sense, but if you are someone who has a large amount of cash reserves and you're not wanting to purchase the property in cash for one reason or another, maybe you've got it tied up in investments, or you just want to have that mortgage interest as a tax write-off, if that makes sense for you, what we can do is take your assets that you currently are holding, and we are able to divide the total of that account by 240. And then whatever that number is, that is the amount of qualifying income that we can use. Now, this is only for conventional loans and only for loans that will be going to Freddie Mac. So it's very specific. This is not something that happens super often, but if you are someone with a large amount of cash reserves and maybe a fixed income or just not a lot of income and you're worried about qualifying, make sure you ask if asset depletion could be a good option for you. My name is Jessie and I am a mortgage loan officer. My goal through these videos is to help educate you about the home buying process and answer questions that you didn't even know you had about financing a home.